What if I told you about a radical plan? A plan so big it sounds unbelievable. The US Federal Reserve might be considering a $5 trillion move. You heard that right, $5 trillion. It's been done before, a historical repeat that could rewrite the rules. This isn't just about numbers, it's about power. The US dollar, the US Treasury, the Federal Reserve, gold, a high-stakes battle. We're about to dive deep into a financial thriller, a historical treasure hunt that could shake the global economy. Buckle up because we're about to uncover a story of debt, gold, and economic maneuvers. To understand this potential $5 trillion earthquake, we need to rewind the clock. Let's journey back to 1934. The Great Depression had the world in a chokehold. Countries were drowning in debt, including the United States. Back then, gold was king. Dollars were essentially IOUs, promises to pay in gold. The US government, however, had a big problem. It owed a mountain of gold that it couldn't pay back. Enter President Franklin D. Roosevelt. He signed Executive Order 6102, also known as the Gold Reserve Act of 1934. This act allowed the government to confiscate gold from its citizens and devalue the dollar. Overnight, the dollar lost a significant chunk of its purchasing power. Why did FDR resort to this drastic measure? The answer is simple: debt. The US government was in a bind and it needed a way out. By devaluing the dollar and changing the price of gold, FDR effectively expanded the country's money supply. It was a risky move, but it worked. The US averted a complete financial meltdown. Now, fast forward to today. The US is once again staring down the barrel of a debt crisis. We're talking about a staggering $35 trillion in debt. The problem isn't just the sheer size of the debt, it's the cost of servicing it. The interest payments alone are a crushing burden on the economy. Just like in 1934, the US is running out of options. So what can be done? To truly grasp the significance of the 1934 Gold Reserve Act, we need to rewind the clock even further. Let's travel back to a time when the world operated on a gold standard. Picture this: money wasn't just paper, it represented something tangible, gold. In this system, countries tied their currencies to a specific amount of gold. The US dollar, for instance, was pegged to $20.67 per ounce of gold. This gold standard provided stability and confidence in the global financial system. It acted as a safeguard against unchecked government spending and rampant inflation. Imagine a world where you could walk into a bank and exchange your paper money for its equivalent value in gold. That was the reality under the gold standard. However, the winds of change began to blow as the world plunged into the chaos of the First World War. The conflict disrupted global trade, strained economies, and forced countries to abandon the gold standard. The gold standard, once a symbol of stability, was cast aside in the face of unprecedented global turmoil. The 1920s roared with economic prosperity, but the party came to a screeching halt with the stock market crash of 1929. The Great Depression swept across the globe, leaving a trail of financial devastation in its wake. Banks crumbled, businesses shuttered, and unemployment skyrocketed. Amidst this widespread panic, a new threat emerged: a gold crisis. As the Depression worsened, people rushed to withdraw their gold from banks, fearing that their savings would vanish. This run on gold depleted the reserves of many nations, including the United States. The gold standard, already weakened by the First World War, began to teeter on the brink of collapse. The situation grew increasingly dire. The gold standard, designed to provide stability, was now exacerbating the crisis. Countries were stuck between a rock and a hard place. Sticking to the gold standard meant sacrificing economic growth and risking further deflation. Abandoning it, however, could undermine confidence in their currencies and trigger even more financial chaos. In 1933, Franklin Delano Roosevelt took office as the 32nd President of the United States. He inherited a nation crippled by the Great Depression, a nation desperate for leadership and a plan. Roosevelt immediately embarked on a series of sweeping reforms known as the New Deal. He said that this would provide relief, recovery, and reform to the battered American economy. One of the most controversial aspects of the New Deal was how Roosevelt decided to address the gold crisis. In April 1933, he signed Executive Order 6102, which effectively outlawed the private ownership of gold by American citizens. This executive order sent shockwaves throughout the nation. Americans were ordered to surrender their gold coins, bullion, and certificates to the Federal Reserve in exchange for paper currency. The government argued that this measure was necessary to prevent further depletion of the nation's gold reserves and to stabilize the banking system. Despite the controversy, the confiscation of gold proceeded. Today, the U.S. finds itself in a situation eerily similar to the 1930s. The debt has reached astronomical levels. We're talking about trillions of dollars, folks. Those trillions represent real money, real resources. It's like having a giant credit card bill that keeps growing. And just like in the 1930s, the government is running out of options. They can't keep raising the debt ceiling forever. They can't just print more money without risking runaway inflation. Some economists argue that a dose of austerity is needed, but that's a tough pill to swallow. Others say that we need to raise taxes on the wealthy. The truth is, there are no easy answers. Meanwhile, on the other side of the world, China is watching and waiting. They've been quietly accumulating gold for years. They know the dollar's dominance won't last forever. It's a high-stakes game of chicken. Each side hopes the other will blink first. The US is reluctant to give up the dollar's status. But China is a rising economic superpower. They're pushing for the yuan to play a greater role in international trade. The question is, who's going to blink first? But here's the real kicker, folks. No matter what happens with the US-China power struggle, one thing is certain: inflation is coming. It's already here, simmering beneath the surface, and it's only a matter of time before it boils over. Think about it. The government has been printing money like it's going out of style, pumping trillions of dollars into the economy in response to the pandemic. At the same time, supply chains are disrupted, and there are shortages of everything from computer chips to lumber. When you have more money chasing fewer goods, prices go up. It's basic economics. And yet, the Federal Reserve keeps telling us not to worry, that inflation is transitory. They're wrong. Inflation is here to stay, and it's going to get worse before it gets better. The value of your savings is being eroded every day, and the purchasing power of your paycheck is dwindling. This is a silent thief that's stealing your wealth right before your eyes. Now let's talk about Fort Knox, that legendary vault where the US stores its gold. The US has a massive stockpile of gold, rumored to be around 147 million ounces. But here's the catch. The gold is currently valued at a measly $42 per troy ounce. What if the US decided to revalue that gold to $20,000 a troy ounce? It would add a whopping $5 trillion to the US Treasury's balance sheet. A bold move, showing the world the US is still a financial force. But here's where things get even more intriguing. Remember China, the economic powerhouse quietly amassing gold? Well, they've been playing the long game, accumulating vast reserves of the yellow metal. Some estimates suggest they could have as much as 20,000 tons stashed away, maybe even more. And they're not just hoarding it, they're starting to use it. China has been quietly backing its currency, the yuan, with gold. They're making moves to position the yuan as a rival to the US dollar, as the world's next reserve currency. It's a power struggle of epic proportions, with the future of the global financial system hanging in the balance. Now imagine this: China announces that the yuan is fully backed by gold. The value of the yuan skyrockets, and suddenly the US dollar looks a lot less appealing. Countries start dumping their dollar reserves, opting for the stability and security of gold-backed yuan. It could happen, folks, and it could happen fast. By revaluing its gold reserves, the US could preempt China's move, bolster the dollar, and maintain its grip on the global financial system. Let's break down the potential risks and rewards of this audacious plan. A gold revaluation could help reduce the debt burden and boost confidence in the dollar. But there are significant risks, including global backlash and domestic opposition. The global financial system is complex and unintended consequences are possible. It's a gamble, no doubt about it. Will the US take the gamble? Or fold and risk losing it all? The potential US move to revalue gold has sent ripples of speculation through global finance. Whispers of a new Bretton Woods agreement are swirling among economists and policymakers. Could this be the moment to rethink our relationship with gold and reshape global finance? The original Bretton Woods Agreement established the US dollar as the world's reserve currency, pegged to gold. This system ushered in an era of unprecedented economic growth. However, it eventually crumbled as the US printed more dollars than it had gold. Now some experts believe a new Bretton Woods is needed for the 21st century. Make no mistake, folks, we're already in the midst of a currency war. It's a silent war, fought with interest rates, exchange rates, and government policies. The stakes are incredibly high. The value of your money, your investments, your very livelihood is on the line. The US has long benefited from having the world's reserve currency. But that privilege comes at a cost. It forces other countries to hold dollars and subsidize the American economy. China and other emerging economies are fed up. They're looking for alternatives, accumulating gold, promoting their own currencies, and developing alternative payment systems. The US won't give up its position without a fight. Expect more currency interventions and trade disputes. The currency war is heating up and it's going to get messy. The US-China economic relationship is at a crossroads. For decades, the two countries have been inextricably linked, with China supplying cheap goods and the US providing the consumer demand. But that relationship is fraying at the edges. Trade tensions are rising, accusations of unfair trade practices are flying, and both sides are looking to diversify their economic partnerships. Some analysts believe that a decoupling is inevitable, that the US and China are destined to become economic rivals, if not outright enemies. Others argue that a complete decoupling would be disastrous for both sides. It would disrupt global supply chains, lead to higher prices for consumers, and stifle economic growth. They believe that the US and China need to find a way to coexist, to manage their differences, and to cooperate on areas of mutual interest. The path ahead is uncertain, fraught with risk and uncertainty. But one thing is clear, the US-China economic dynamic is shifting and the world is watching anxiously to see what happens next. Let's face it, the idea of the US government revaluing its gold reserves is a bold one. Some might even call it downright reckless. But sometimes, a little audacity is exactly what's needed to shake things up. Think about it. The US is drowning in debt. The interest payments alone are a crushing burden on the economy. The dollar's dominance is waning and China is ready to pounce. In this environment, playing it safe is not an option. A gold revaluation, while risky, could be the game changer the US needs. But hold on a minute. Before we get too carried away with visions of economic grandeur, let's take a cold, hard look at the potential downsides of this high-stakes gamble. Because let's be clear, revaluing gold is not a magic bullet. It's a risky move with potentially far-reaching consequences. First and foremost, there's the risk of unintended consequences. The global financial system is a complex web of interconnected markets and institutions. Tweaking one part of the system can have ripple effects that are difficult to predict, let alone control. A sudden surge in the price of gold, for example, could send shockwaves through commodity markets, destabilize currencies, and even trigger a wave of defaults. It could also lead to a global currency war, as other countries scramble to protect their own interests. Then there's the issue of inflation. Injecting trillions of dollars into the economy could ignite the fires of inflation, eroding the purchasing power of consumers and businesses alike. Imagine going to the grocery store only to find that the price of milk has doubled, or that your rent has skyrocketed overnight. Clearly, we need to navigate this minefield. So, what is an investor to do? In a world of uncertainty, how can you protect your wealth and profit from chaos? The first rule of investing is always the same: don't panic. Take a deep breath, assess the situation calmly, and remember that knowledge is power. Understand the forces at play: debt crisis, currency wars, and the role of gold. Remember also that now is not the time to be complacent. Traditional safe havens may not provide the same protection. Consider these 4 alternative investments to hedge against uncertainty. First, gold is the classic safe haven asset. It performs well during economic turmoil. Second, silver is another hedge against inflation. Third, real estate can be a good investment during uncertainty. And fourth, cryptocurrencies are a new and evolving asset class. This leaves us with the inevitability of change. The financial world is on the brink of a seismic shift. The old order, with the US dollar reigning supreme, is crumbling. The rise of China, the looming debt crisis, and the specter of inflation are forcing a reevaluation of the global financial architecture. We're entering uncharted territory, folks, and the rules of the game are changing. Change can be unsettling, even frightening, but it can also be an opportunity. The key is to recognize the inevitability of change, to adapt to the new realities, and to position yourself to thrive in the emerging landscape. The old playbook, the one that told us to put our money in stocks and bonds and call it a day, is no longer sufficient. We need a new playbook, one that accounts for the risks of inflation, the volatility of currencies, and the rise of alternative assets. The good news is, you don't need to be a Wall Street whiz to navigate these turbulent waters. You just need to be informed, proactive, and willing to adapt. We need to take hold of the power of preparation. The best time to prepare for a storm is before it hits. The same is true for your financial well-being. Don't wait until the crisis is upon us to start thinking about how to protect your wealth. The time to act is now. Start by educating yourself. Read books, articles, and blogs about economics, finance, and investing. Follow reputable financial experts on social media. Attend webinars and seminars. The more you know, the better equipped you'll be to make informed decisions. Next, take a close look at your finances. Do you have a budget? Are you saving enough? Do you have adequate insurance? Are your investments aligned with your goals and risk tolerance? If not, now is the time to make adjustments. Don't be afraid to seek professional guidance. A financial advisor can help you develop a personalized plan based on your specific circumstances. But choose wisely. Look for an advisor who is independent, fee-only, and has your best interests at heart. So here is your financial freedom playbook. Your key strategies to consider. 1. Diversify your investments. Don't put all your eggs in one basket. Spread investments across stocks, bonds, real estate, precious metals, and cryptocurrencies. 2. Consider gold and silver as safe haven assets. They hold value during economic uncertainty and hedge against inflation. 3. Explore real estate for income and tax advantages. 4. Think long-term. Stay focused on your plan. Be prepared to weather the storm and emerge stronger. Shape your financial destiny. Don't let it pass you by. At Dollars and Cents, we're here to keep you updated on the latest developments that could impact your financial future, to help you become more financially secure, and to better understand how these changes might affect your wallet. We'd love to hear your thoughts. So drop a comment below and let us know what you think about this potential shift by the Fed. Also, share this video with your family and friends to help them stay informed about the financial world around them. Stay informed, stay prepared, and I'll catch you in the next one.
I bet you didn't know managing money could be this easy. Subscribe now and get the latest finance tips and tricks straight to your feed. From saving smarter to investing better, we've got you covered. Don't miss out. Hit that subscribe button today.